Rana Gupta is with us, Senior Portfolio Manager and India Equity Specialist at Manulife Investment Management. Rana, good to have you with us here. Thanks very much. You know, we can sort of talk about why the GDP number was 8.4 as compared to 6.4. I think is a large jump in indirect tax collection. But even then, the fact is this has led to the street upping their forecasts for what the real GDP growth could look like in FY25. So we find ourselves in a pretty good place.
Morning. Yes, that's true. I think the GDP growth numbers are quite strong. And within the GDP, I think the investment numbers are quite strong. So I think that has been our stance, that India will have a pretty solid GDP growth going forward. And within that, investments will do better than consumption. I think that is a big pivot in the policy that has happened. Taking a step back, if you look at last 10 years, and as I was alluding to our earlier conversations, that because of strong tax collections, fiscal deficit is coming down, and within the spending, capex is going up a lot more than revenue expenditures. All this putting inflation down and putting growth up. So it's a pretty good mix that we are looking forward to.
And the GDP growth acceleration came largely on the back of a 32% rise in net taxes. So that was the big positive, the fact that tax collection has improved quite a bit. It just goes to show that the economy is growing on all fronts, right? What does this mean for an equity market observer? Because we've had a very good run up until now. Do you think we can build on to our gains?
Sure, I think of course, it shows economic resiliency and also better tax compliance. So all that has definitely improved. Now, in terms of stock market returns, of course, there is a price to pay for it. So I think it's better to go more focus on specific sectors. Also, another aspect of this high tax collection is that government, the policymakers now have the power to give certain incentives or production-linked incentives, manufacturing incentives to certain sectors. So our preference is that the sectors where the government is pushing manufacturing through import substitution, encouraging on value addition, or even encouraging exports, those areas I think can further build onto their gains.
All right. Hi, Rana. Morning. Good to see you in. What about the approach to equity markets? When we last spoke, you were hinting at the Japanese index as well, continuing to outperform. It's woken up from that slumber, and it's done very, very well, the big outperforming market. So, in terms of preference between emerging market, developed markets, the US is doing well, Japan's doing well. What's the preference as of now?
Look, I think I can only share the observations. I am not in the role of asset allocation to pick one market to another. But what I observe is that among the developed markets, US and Japan, they continue to do well. But US is largely tech-led, and Japan, as you know, is more of the restructuring of businesses, and old businesses doing well. In fact, very recently, even South Korea is joining that. Their exchanges are asking company to quote unquote called value up, look for better shareholder value creation, so on and so forth. So I think those things are happening. Even in some of the ASEAN markets are doing well. Indonesia had the election done. The stock price is the market is not too expensive, so on and so forth. So I think all these markets are a good place. But India, given its 4 trillion economy and the 4 trillion market cap, it's a very large liquid market where reforms have happened, and where I think increasingly people looking at it, that can it be something like what China was in early 2000s. So within emerging market space, in terms of its size and the growth potential and the amount of value it can add, I think it stands out quite a bit.
Okay, all right. Thanks a lot for that. Appreciate your thoughts here. By the way,